Welcome to the latest MoneyWise UK and Quantcurl podcast. I'm George, the founder of MoneyWise UK, and I'll be the host today. We're delighted to speak to Joe and Christoph, the founders of Telsons Investors, about the challenges and opportunities of running a boutique fund manager, debating active versus passive, and learning more about global funds and the nuances within this sector. Good morning, Joe and Christoph, and thank you for joining us for this podcast.
Morning, George.
Morning. Great to speak to you. Can we just start with perhaps just a brief introduction to Telsons and kind of how it all came together?
So, George, gosh, that was over 10 years ago when Christoph and I, and coming out of AllianceBernstein, and John Bishop, who I'd worked with back in the 90s at Paribas, we all came together really out of response to the financial crisis and how to some extent there was quite literally this sort of crisis of confidence in markets, in counterparties, in services, funds, banks, regulators, and this idea that we should put a business and a fund together that people could have a real sort of touchstone, transparent confidence in. And the character of Telsons itself was supposed to carry that, and the nature of the fund, the Endeavour Fund, prolonged industrious effort, where you're putting your capital to work, which does involve some risk, but not so much risk that you might lose confidence along the long-term journey. So a sort of, a mid-risk proposition to carry a mid-risk kind of philosophy. So I think very much thinking about the trauma that was the financial crisis and an attempt to try and put something together that might give people, more confidence over the journey. Wouldn't you say, Christoph, that's how we sort of came together on it?
Absolutely. Yeah, we came out of AllianceBernstein really trying to put something together that we feel very comfortable ourselves with, because we have put most of our money into it, and that's how we like money really to be managed.
Yeah, that's fair too. This is how we wanted to give ourselves reassurance in the most uncertain world coming out of the financial crisis.
So that leads me on to another question. I was going to ask you about challenges of a boutique fund manager, which I will ask you, but kind of thinking more about this index strategies that kind of are gaining a lot more traction, or certainly voice. And obviously you've come out of, where this was formed, where it came out of, this kind of active management. And there is this sort of feeling that, where does the active management sit, and is it worth paying for that? I mean, obviously you've kind of set this up because you want to develop something that responds to something that's happened, but then you've got this counter argument, haven't you, of actually what's the point? We might as well just go passive. So how do you think that is changing, and how do you feel about that?
Well, look, that's something that we think about a lot, and I think, wrapping, if I might, the two concepts a little bit together, boutique and passive, are two sides of the same coin that we thought about when we started, and which is bearing on the whole industry with immense pressure right now. So let me explain what I mean by that. So we would say that the problems of boutiques and the flow towards passive are both principally a result of regulatory action. And we can see a lot of rationale for a great deal of the regulatory response to the global financial crisis. But we also feel somewhat surprised by quite a lot of the regulatory response, in many ways, that never materialized. A regulatory response that we thought would happen making businesses and risks in the industry more transparent, more manageable, more modular. None of that's happened. We would suggest that actually systemic risk in the industry has only increased, particularly through the concentration of assets into the harbors of just a few very, very large organizations. We don't think that's good for the industry. And so if you think about, a few handfuls now of asset management companies managing trillions, anyone with less than $1 trillion you could consider to be called a boutique. So we're all boutiques now, in the sense that we are smaller rather than bigger, less scale, but potentially less risk to us. The boutiques are still managing the bulk of the money in whatever form, notwithstanding the fact that some of these giants are managing many trillions of assets between bonds, actives, passives, equities, and whatever. It's the smaller, mid-sized businesses. Boutique, we think, is a rather odd term to use for small, specialized businesses. You don't talk about boutique tech companies, do you? You don't talk about boutique industrial manufacturers or precision instrument manufacturers. You just talk about smaller, mid-sized companies that are highly specialized, very agile, probably less risky than the larger international conglomerates in the business models and the governance structures. And we are still managing the bulk of the money. And many boutiques continue to thrive and are under greater pressure, good market pressure, to perform and deliver excellence of service and customer outcomes. But the other side of this coin is also that passive is growing. There is no doubt about it. In every market, regionally, globally, passive, probably manages half, if not more, of all assets. So where do we see that opportunity is somewhere between passives controlling half of the market and the whole of the market, let's say perhaps in the next 5, 10, 20 years. The active opportunity only gets richer because, broadly speaking, passive markets cannot price risk by definition and cannot price new capital, which is the fundamental purpose of markets, is to raise capital for a productive endeavor. And you need some kind of sentience to price this risk appropriately. So as passives continue to grow, we believe that the active opportunity only gets richer and more intense and potentially more rewarding. So that's what we're playing for.
And it's funny, isn't it? We talk about smaller fund managers as boutiques, and I think you're right. Is that if you strip that away and look at them, a lot of them are just specialized businesses in particular areas. And I guess one of the things is that we're in this kind of world of consolidation, aren't we? A consolidation, whether it's with financial planners or whether it's with fund managers. And I guess one of the things that is uppermost in my mind is kind of when I was previously managing portfolios, and I liked those kind of smaller specialized businesses to come in because their funds tended to offer something a little bit different. As the market gets or appears to get squeezed, does that put additional pressure on you to raise or to, I guess, raise the profile of your fund, to actually find people that are going to invest in it? Because I guess if you take a big company that's consolidating, they're probably not going to look at you, are they? And I don't mean that in a bad way. It's that they're just not going to look at you. They want to go for the big names that they know. So it'd just be interesting to see how that market, how you think about what's happening at the moment.
Well, look, that is a reality, a harsh reality for us. I think, we're still small, We may be more than double the size we were when we started, but we're still a lot smaller than we aimed to be at this stage. The specific reasons for that for us at Tellson's, very tragically, have been because we lost our co-founding partner, who was responsible for business development, to cancer in 2018. All the work that he did for us to lay the groundwork for the distribution, for the voice, for the brand in the early years was lost. It took us a while to find a replacement. Difficult to hire top quality business development people into a small company, a small partnership with just one fund. And by the time we did find replacements, we were hit with COVID. We were locked down, and for various reasons, we didn't qualify for any financial assistance in the business. So it cost us a fortune in money, and it also cost us greatly in terms of our very best performance was coming through in 17, 18, 19. Actually, ironically, during COVID itself, we were one of the top 4 managers in our category. We really knocked the cover off the ball in these years, receiving our 2nd nomination for Fund Manager of the Year, but we had no voice and we had no traction. We had no ability to get out to meet wealth managers, advisors. They very substantially stayed at home in the years since too. So ironically, over 10 years with over 10 years, a 10-year rolling period, let's say, of our investment objective, 5-year returns, we have been top quartile or top decile in over 80% of those rolling periods. And yet really struggled to capture that voice, really struggled to get out there and find the people who can look at a small fund like us, who can look at the investment process, who are interested to see something different. It's been far, far harder than we thought. And again, the regulatory framework that we've got over the last 10, 15 years has definitely made that harder. The gatekeepers, the rating agencies that now have a stranglehold on a lot of advisory flows, they themselves, for their business models and their role within the regulatory corridors, it makes no sense for them to try and rate us, give us that rating, give us that handle that is so important for visibility, credibility in the structure of the wealth management and advisory industry today. We've had it very, very clear from these guys, they're not going to rate a small outfit, no matter how good our performance is, when they can compare our resources to so many larger organizations. And they can look at the size of our fund and say, you are simply not being used by enough of our customers for us to be worth our while trying to cover you, trying to cover the detail of your processes, your risks to service our own clients. So it has become a very complicated regulatory environment. We thought we understood the regulatory challenge when we started and designed a business with the very lightest, simplest, clearest, most transparent regulatory footprint. Absolutely what we thought the regulator would want to see more of in this industry. But ironically, all those things conspire to make us, smaller, less diverse, less full service, narrower in our perspective, and harder to find headway and gain that traction.
And I was going to lead on to, because I know that you've looked at the strategy, you've changed it, and I was going to move on to that and ask around the change of name. Before I get to that, the one question, and I think you talk a lot about regulatory, and one of the arguments with passive is the cost element. And my personal view is less about cost, it's more about value. And I think you have to understand the value proposition rather than keep focusing on the cost. So is that a pressure also when you talk about regulatory pressures? And I know that there's lots of different ones, but does cost also, is that uppermost on your mind when you're thinking about things? Or are you trying to sort of just focus on that value, which I guess is where maybe this change of name and strategy comes in a little bit.
Yeah, I think value is a good concept, and it carries a lot of things. We really set out at the beginning to offer utility to investors. You know, the whole idea of Endeavour was supposed to carry, prudence, a level of risk that should give people reassurance and a sufficiently concentrated range of investments, again, that people could get a grip on, get confidence from, and that this subset, relatively concentrated subset of strong companies, should give long-term investors more confidence to stay the course than the market. The fundamental principle here is that the market can be pretty crazy, and when it's having one of its bad periods, what do you fall back on? What do you hold on to for to stay the course? And fundamentally, what we were trying to propose really was that no matter what the market may be feeling or waking up about from one day to the next, these are the kind of companies whose business models and franchises and products and leadership and management culture should endure. Durability, sustainability has always been a very, very couple of key watchwords for us in our research process, our stock selection. And that was true also when we were investing in bonds. So I think value, part of the value proposition has to be that subset that gives people more reassurance for the long term. You could call it, secular growth. You could call it quality. You might call it defensive. Funnily enough, we call it, 2 or 3 of exactly those things in our investment process, which hopefully we'll come along to in a few minutes, and probably when I stop talking so much and I hand over to my dear partner here, Christoph. But coming back to this idea of value, and we also meant it to be cost effective for investors. Any asset flow into our fund today is fee revenue straight to the bottom line for us, because we run a very, very lean and focused ship. It doesn't cost us a lot to run our business by design. So actually, we've got share classes on the Endeavour World Equity Fund that are amongst the very cheapest in the marketplace. Does that register with investors? Does that make the difference? It should do. If we can find the voice and we can get out there and find the investors, they will see that. And hopefully they will marry that up with a long-term track record in the top decile or top quartile over rolling investment horizons. And they'll see that, there's a lot of what we put together that is what they want, that ticks the boxes, and that does deliver good value. How we find that voice in this increasingly, as you say, consolidated marketplace, this increasingly disintermediated marketplace, platforms, rating agencies, gatekeepers, fund of fund selectors, so far removed from the underlying investor. We've got to be able to cut through all of that. But the possibilities are, there are a lot of boutiques, small startup businesses over the last 10, 15 years that have become very successful. And there's every possibility that we can do that too. But yes, we've had to make changes to the fund mandate, to the structure of the fund, the objective of the fund, in order to optimize that concept that I started with here, the utility to investors. And a lot of investors were seeing us doing a good job across a range of assets. We had global equities, we had corporate bonds, we had government bonds, we had precious metal exposures, we had active currency management, and even if we were doing a good job, we had it from the rating agencies themselves to say, are we going to put our seal of approval on your team's capability to deliver best-in-class outcomes across all these different asset classes, when even if you're beating the likes of JP Morgan or Schroders or Goldman Sachs, it just doesn't look as though you should be beating them over the long term. So, we're just not going to hang our hat on that coat hook. And so we recognized the need to do less of what we were doing and make sure that we could be seen to be doing it to the very best standards. So we've cut out corporate bonds, we've cut out dynamic asset allocation, we've cut out the dynamic risk off currency management that actually we were doing extremely successfully. We've cut out all kinds of derivatives that made certain people feel less comfortable. We've slimmed and trimmed it right down to the core equity process, from which, the 10-year track record demonstrates a really compelling offer of probably top decile, certainly top quartile global equity returns. And when you add risk-adjusted return to that equation, actually what our strategy would have done over the last 10 years with the equities that we actually invested over the last 10 years that are still very much the equities that we have in our portfolio today, we'd have delivered a 10, 11% annualized return with probably about a 10, 11% volatility. And that is a really worthwhile goal, a really worthwhile service to provide to investors. We simply need to become known for that.
Do you still have that? I'm sure I read that there was still some alternatives within the strategy, a small amount, or is it now just purely equity?
Well, no. So that's a fair question. We wouldn't call them alternatives. I think the phrase alternatives out there today implies really different types of asset class, whether that might be infrastructure or private equity or venture capital or real estate. I think what we would say is, any global equity fund has a pocket that they can allocate to cash or money market instruments or some such other. And in fact, there are some very famous equity funds that fairly consistently run, reasonable sized positions in that stuff for a whole host of strategy reasons. What we're saying is, let's have some negatively correlated exposures in this essentially global equity portfolio that we can carry over time without too much drag, but which really offer some powerful shock absorption in the bumps along the journey, to keep people, on the journey, comfortably carrying on the journey rather than bailing out and all too often crystallizing the losses. Now, look, there's not every investor that cares about that. The very long-term investors who can really afford to be very long-term, maybe the wealthier, the family office, the institution, might not worry too much about the bumps along the way. But the modern retail fund industry, I think, cares a lot about that. And what we're saying is there's a small allocation here baked into the strategy of genuinely negatively correlated exposures to your dollars, your yen, your Swiss franc, very modest exposure through ETF to longer dated government bonds. And these things tell. When you really need diversification, funnily enough, it's not a lot of the alternative or diversifying asset classes that have become such ubiquitous features of diversified portfolios, client portfolios over the last 20 years. A lot of that diversification is to some extent misleading. It's structured, it's packaged, it's less liquid, it's to some extent opaque, trades by appointment if you're lucky. The crises we've seen in liquidity squeezes on numerous occasions over just the last 10, 12 years in real estate exposures, property funds, where they've been gated, causing quite a lot of concern to market participants and regulators and customers alike, where there's really no liquidity in that so-called diversifying asset class, and indeed poses a serious threat to the evolution of the entire MPS marketplace, for example. So we think that alternatives and diversifiers can be quite dangerous concepts, can be quite misleading, I think, and that ultimately what we've got a small sleeve to here is genuinely negatively correlated. The very few genuinely negatively correlated exposures that really work in a market drawdown. And we think that is there to provide a bit of stability, a bit of what we call keel, not ballast, but real keel to the boat. keeps it upright, keeps it stable, and actually keeps it moving forward in the long-term journey.
I guess like starting to get a feel as to how you stand out as a global fund. But I think the other thing that strikes me, and again, I guess it's back to that kind of passive argument, is that, and my figure's probably slightly out, but I think the US market was around about 50% of the index in 2008, 2009, and now it's about 70%. And you just get a feel that when you buy a global fund, all you're buying is the US. Well, you're just buying a US fund with a little bit of some other countries thrown in on the side. And I'd be interested to know kind of how you think about that, because a lot of people could argue that a global fund, all you have to do is just buy the US and then away you go. And in fact, all you're doing then is just having a US fund. So how do you think about that? And again, having this, however we call it, this sleeve, this all these different things that you do, obviously that's how you're making yourself stand out. But there must be that pressure that almost, actually, I just buy all the US, all the big US stocks and away I go.
Well, it's certainly more of a problem today than it was, as you say, 10, 15 years ago. But it's not the first time in even the modern experience where something like this has been the case. You go back 20 years before that, and Japan was worth more in the index than the US. And people might have said the same thing and had a similar kind of problem back then at the beginning of my career. You also could say over the last, I don't know, well, certainly my career lifetime, the last 30 years or so, the UK portion of that global index has shrunk by almost 80%. So you're always going to get these shifts. And that's, I think, very much part of the day-to-day job of managing a portfolio of investments. You can choose to be concentrated and local. You can choose to be diversified and global. And you can go, hopefully, with a mandate, wherever you feel you need to go to find what it is your investors are expecting you to find. But look, the bottom line here is that the US economy has been, over the last 20 years, just so much more successful than any other. And a good chunk of that is in the concentrated business models of a few of the world's very largest tech, digital, media platforms. And these are truly extraordinary companies. We actually happen to have confidence in a few of them and have done for many years. We've invested in some of the Mag 7 that everyone's talking about now, as if they were some collectively homogeneous group of companies, which of course they're not. They just happen to be big and growing at a phenomenal rate and investing for that growth and leading their markets in their very different business propositions. We don't like them all. We like some. And on average, we've been invested in them for over 6 years. And we remain invested in them. But in aggregate, they only account for, I don't know, a quarter, maybe less than a quarter of the portfolio. There's plenty of other opportunities outside of those kind of companies across US industry sectors and indeed global industry sectors. Let me bring you to, I think, a very good example of why you might find something outside the US that is really unique and just as attractive as anything you might find there. A company like Reed here in the UK, or Relx as people might refer to it. We see that as a relatively defensive company. It's an industrial company, but with what we would say is a very tech-focused unique data future, very well suited to the potentials for artificial intelligence. Now, that is actually a company that you might expect to find perhaps more likely in the US marketplace, but it's here. And it's been in our portfolio ever since we started. And I think delivered us an extraordinary total return of around 500-600%. And it'll stay in our portfolio. But I think this is the point, is that when you're looking for global leadership in your sectors, you're going to be large cap. And whether you're domiciled in the US or the UK or somewhere in Europe or Japan, generally we have developed market exposures here. your revenues, your footprint is truly global wherever you're domiciled. So yes, we might have a big chunk of exposure, a market-weighted exposure to the US marketplace, but these are, probably 40, 50, 60% global revenues. And the same goes for the companies we own in the UK and in Europe and Japan. So these are truly global companies, wherever they're domiciled. Global client base, global product leadership, global revenues. And I think that's the beauty of investing globally, is you can get your local exposure if you want it. You can get increasingly today portfolios of genuinely globally diversified, globally leading businesses. The fact that less than half of our portfolio by name is actually in the US, is neither particularly significant or a concern for us.
So kind of leading on to your fund, I know kind of wrap a couple of questions into one. So it may sound like there's loads that I'm putting into it, but I know that you talk about this kind of unique process you use. I think what would be really helpful is obviously a bit of an explanation around it and perhaps why. So you often hear people say, oh yeah, we've got this unique process, but all it is just a name. It's just something that's already out there. It'd be interesting to talk about that. But also, I think probably it will come out when you're talking about the process. You talk about focusing on a small number of companies, which some would argue that a small number of companies increases your risk. And so it would be interesting to see how that kind of flows into that, and whether you can engage with those companies or whether you don't see that as important. So if that makes sense, it'd be really interesting just to kind of understand more about your process and that idea of small companies engagement and so forth.
George, it's Christoph here. Hi.
Hi.
So I think if we start, we think it's quite unique, our Petra investment process. Clearly, the components we are taking and making use of are not revolutionary. We look at balance sheet, profitability, cash flow, etc. But it builds on a tool that's been used quite a lot, but in only one segment of the market, the growth segment, called PEG. So we really have developed something which we feel is much more rounded, well-rounded, and applicable to the broadest universe. And that is by adding to earnings growth the feature of looking at dividend yield. Because if you add earnings growth and dividend, you get to total return. And total return is actually what ultimately drives the share price. And so it enables us to look at not just growth, as I said, but also low growth companies. For example, a company we have liked and invested since the start, the Dutch bank. You may say it's so boring, but they're one of the cost leaders, very strong balance sheet, and they have been highly innovative around digital service offerings. And we even labeled them as one of the early fintech solution providers. And they have actually generated tons of cash, which they're now paying back to shareholders. This and next year, we believe they're going to be giving back about 15% of the market cap, 50% coming from dividend and 50% coming from share buybacks. And why is it possible? Because they're growing, they're cash generative, they have a strong balance sheet, and they're very disciplined operators. And that brings me to a core philosophy and thinking, what we aim to find. We aim to find great companies that we have defined as structurally, operationally advantaged companies. These are companies that in whatever they do, they are able to generate some sustainable growth. How and why? Because they have a focus on innovation, a focus on further developing, for example, in the likes of REIT or in the likes of ING, new products, new service offerings, which the market likes and takes up. And in addition to that, the operational excellence we also seek from companies is vital because it provides the basis of a company. We like companies that are cost leaders and therefore highly profitable. That should bring with it very attractive cash generation, cash returns above cost of capital. And these are the kind of companies, through the generation of cash, they can use that for organic investments and growth. And because they are disciplined, they maintain an efficient balance sheet. What do I mean by that? Neither too leveraged nor too under leveraged, and are disciplined to pay out any excesses in cash back to shareholders, which is where we come back to dividends. Ideally, they pay that back in form of cash dividends, maybe also in addition to share repurchases. So that's sort of covering in a nutshell. I know very, very quickly of what are the elements that we look at when we run our Petra investment process. It's structural growth and operational excellence, which should give us a company that is durable, dependable, and predictable, and should generate a more attractive risk-adjusted, what we call Petra score relative to the market.
Thanks for that, Chris. George, I think to summarize that for simplicity, I think there's a lot of moving parts to Christoph's research and investment process. But I think the core differential here for a very well-established concept like PEG, the PEG ratio, that's been around for decades, that people are familiar with, is that we're going further, as Christoph says, more rounded, more sources of return, but adjusted, crucially, by fundamental research for a whole range of risk factors and confidence factors. At the end of the day, when you're picking a stock, it's because you've got a high level of confidence around risks to execution, risks on the balance sheet, risks at the management level, disciplined prosecution of the business plan, capital raising, mergers and acquisitions activity, a whole range of risks about which you burnish your level of confidence. And that's where our PE total return fundamental research adjusted, so the Petra, gets us to, if you like, raw valuation metrics like P ratios and PEG, adjusted for a whole ton of conviction and confidence. Not all PEs are born equal. You could have a stock today with a PE ratio of 8, like ING, and you could have a stock today with a PE ratio of 8 in the energy space. But with what we've just outlined, shareholders to be receiving from a very strong, clean banking franchise like ING versus where it was in the financial crisis, you're getting, a 15% total return, let alone from the growth profile of that bank, compared to an energy company where there's a great deal of uncertainty around the supply and demand balance, OPEC discipline, geopolitical risks, the stage of the business cycle over the next year or two. So not all PEs are born equal. And we think that Petra is able to cover the broadest spectrum of return, sources of return from different businesses in different sectors globally. And by the way, you can also create an adjusted Petra score for different markets. Nominally, the UK market is incredibly attractive in PE terms and indeed on a Petra basis, but you've got a lot less certainty around the growth prospects and certainly the diversity of industry sector and company leadership in the UK market versus, for example, other strong global leading businesses in different industry sectors that, outside the UK market, typically in the US market or to some extent in Europe or Japan, are offering opportunities for exposure to parts of the economy where you perhaps have more confidence in that growth. So it might not be unique. We certainly think it's different, but it's built on something with very well established credibility and intellectual positioning in the marketplace, I suppose, in the industry. But we think it just goes a bit further. And the reason why we needed it to go further was because of our fundamental starting proposition. Starting the firm, the original Endeavour Fund, with a view to delivering attractive risk-adjusted returns to ensure, the maintenance of that longer-term investment strategy. We've always been thinking about, trying to maximize that return, but with what kind of risks. And so I think Petra really has worked incredibly well for us to capture that. And in the beginning, with the old version of the fund, it had to work for corporate bonds too, alongside equities, within the capital structure of a given company. Where would you get the best risk-adjusted return exposure to this organization? And sometimes we simply said, the better place to be is in the bond. And that was very much what it was calibrated to do right from the beginning. So it's a risk-adjusted return investment process that we think is, well, it's certainly differentiated, if not entirely unique. I'd be fascinated to hear from people if they think that anyone else is using something remotely similar.
Would you say then, because listening to it and kind of your approach to it and how you think about it, and the point I made about 30 companies and do you engage with them? I guess the point of the process is that in a way you don't need to engage with those companies, do you? Because you know them so well. Your process leads you to those right companies, doesn't it? And so that in a way reduces that risk. So sometimes people say, oh, actually, you need to have 100 companies because that lessens your risk. But almost by adopting Petra, what you're saying is actually we know those companies so well, and that reduces the risk. Am I down the right line, or how what do you think?
George, let me say, I think a unique feature that we have a very highly concentrated 30 holdings portfolio that is split up into 3 sub funds, which are very lowly correlated, 0.2 to 0.3 across each other. And that is because they have different themes that are very complementary: secular growth, cyclical leadership, and defensive strength. And we apply this Petra process for each one of them. Each sleeve or sub-fund has 10 names. And this is why we believe, even though at first broad brush you may think 30 names, oh my God, that's way too risky for me, I'd rather buy the index. Because of the highly uncorrelated nature of these fund sleeves, we believe we can achieve very attractive risk-adjusted returns, if that makes sense.
Yeah. But yes, George, to your point, I think you're absolutely on the right track. And that is that Petra is about burnishing our confidence. It's about discounting the risk factors in these companies. So, for example, NVIDIA has been in our portfolio for 5 years. I think 2019 was when we first started investing in it. And we've been prudent as to managing those exposures, the rapid growth in the stock price there. We've had to sequentially keep harvesting, and never allow the stock to play too big a part in the portfolio. But it's been there pretty solidly for the last 5-6 years. Big controversy around it, but the fundamental reason we went into Amazon, Microsoft, NVIDIA, Google, these are our favorite of the tech platforms, was data explosion, and what we saw them delivering in terms of cloud, outsourced data services, the software services that go along with that, servicing their other platforms, whether it was search at Google or e-commerce at Amazon, Microsoft, obviously very much already in the space, and NVIDIA with parallel hyperscale computing. We could see that their tech, their know-how, their product designs were going to be at the forefront of this exploding need for data. Now, of course, that data story has been going on for very much longer, and what we're now talking about in the last 18 months or so is the AI iteration of that. But we don't really sort of need to take a view on whether AI is profitable or not. One thing is absolutely certain, is that the explosion of data continues. and these are the guys at the forefront of this. So there's a very high level of confidence across these business models in further penetrating the marketplace for state-of-the-art, massive scale infrastructure data processing needs. We've got a very high level of confidence in that secular growth driver. And given that level of confidence, and given the if you like, the horizon of secular trend that we can discern, that reduces a lot of risks for us. So risk adjusted, these PEs in the high 20s, the low 30s, we can suddenly get very comfortable with those, right alongside ING at a PE of 8, Iberdrola at a PE of, well, maybe 12, with a total return there of more like mid-teens. You know, these things sit very comfortably alongside each other when you factor for the risks. So you're absolutely right. We think about the balance sheet, we think about the management, we think about the product lines, we think about the valuation, but quite clearly so much more than just the valuation. And it's burnishing that confidence that for us makes these propositions far less risky than the marketplace. And I think that is a crucial part of what you earlier described as the value proposition to investors of active management.
I've got a couple of final questions, and one that fascinates me, and so it'd be quite interesting to know your view, is it's about ESG. So it's kind of in 2020, it became a real sort of buzzword, and you just saw this explosion of large fund managers saying, yes, we've got ESG within our process, and I always struggled with it because you kind of feel that surely when you're looking at a business, you would look at environmental management, social, you know, the governance and everything. It almost felt to me, if you weren't doing that, then you should have been. And all you're doing is you're just creating a name for something that was already there. I know that it not necessarily applies to you, but do you have any feeling on that, or how that may have kind of dented the industry or been positive? I don't know. Do you have any views on that side of things?
Yes, I think that the way we think about ESG is that it's important. We like companies with high ESG scores. Our fund, by the way, is very highly rated when it comes to ESG risk rating. We used to have Morningstar Sustainability Globes, and which were amongst the best out there. Now, if you look at our investment process, ESG is part, but it comes at the end. And that probably shows its level of importance. So we believe, I shall say, that our investment process naturally gets down to finding companies that are successful and have high ESG risk ratings. Why? Because those companies have realized they need to incorporate all those ESG, environmental, social, and governance issues right up and into their corporate strategy. I think one of the best examples I have mentioned to Joseph is just looking at the annual report from Microsoft and coming through and across a section where they talk about ESG. It's fascinating to realize that a tech company like Microsoft has elevated already 4 years, probably 5 to 10 years ago, ESG thinking up to the corporate executive strategy level. And I think this really is a great example to show these kind of companies that aim to find those predictable businesses are those businesses which are mindful of all their stakeholders. Yes. And they've done that already way before ESG was born. But it's not ESG ultimately that we want to have at the core of what we do, but it's great companies that have structural operational advantages and happen to also be good in ESG.
They've been thinking about this stuff for years, for all kinds of reasons. They've wanted to be good players in their local communities. Yes. They've wanted to try to be at the forefront of attracting workers with the most attractive workplace environments, incentives, training, care. They've wanted to show their shareholders and their regulators that they've got the best governance structures. So rather than us finding ESG and the whole of this industry with its greenwashing, that we're all now very concerned about, very disappointed by. It was quite the opposite. It was the other way around. It was really ESG that found us. Our process, as you say, George, you have this intuitive feeling for it. Our process naturally found the companies that have been taking this stuff seriously for decades. Now, that's not true for every single company. And one of the reasons why we didn't clothe ourselves in an ESG mandate specifically was, for example, that we owned Shell, and we still own Shell. But one of the reasons why we've always owned Shell is that we've always believed it to be at the forefront of the move to better fossil, towards net zero, to use their market position, their technology, their know-how, originally migrating away from heavy oil towards gas. That was definitely a positive move, as we now know. But even according to the Paris Climate Accords, there's a clear recognition that the best, the cleanest, the most efficiently operated fossils have a crucial role to play on the journey to net zero. So why wouldn't you own the best companies, showing the best standards, leading the way? ESG and the way that the market adopted it would negate that, would make that impossible, because it all became a negative screening game. Who can be cleanest, purest, the most puritanically uncompromised ESG portfolio? And that was never the objective. The objective was always to reward companies for taking environmental, social, and governance issues most seriously. And we think that Shell is a gleaming example of that in the energy space. As we know, industrial activity is messy, it's dirty, it's a problem in many respects for ESG. But just because they inevitably score perhaps not so well, an ESG fund, as the industry has created it in recent years, would preclude investment in those kind of businesses. And that can't be right. That can't be the point. The point has got to be to encourage the best standards evolving and emerging, no matter what the industry. The moment we found was most extreme was when corporate bonds would systematically attract poorer ESG ratings than government bonds. I mean, how ridiculous is that? And what a disincentive to provide capital to industrial and economic activity. So we were pleased that the way things have evolved over the last couple of years. We were pleased and indeed relieved that our read on ESG was right, that we continue to capture great companies with great effort and great thought put into increasingly aware environmental, social, and governance standards, but not to have actually tried to wear the uniform and convert the fund to an ESG mandate. We're relieved that we didn't do that. But we think that this ESG is not going away. It's just that the industry has to make sure that they're investing it properly.
Thank you. And I mean, this whole talk today for me has been really, really fascinating. And I guess I'm just as guilty as anyone else is kind of looking at you as boutique, but I love the way that you talk about it being a smaller, specialized business. And I think that kind of helps that argument, doesn't it? I get frustrated when people kind of focus on cost and actually it's about value. And I think throughout this is what you've kind of brought through, is the idea of value, but also that kind of risk awareness and how you balance that. And it's interesting how you talk about NVIDIA against ING and all of that. I guess just kind of finally, but from your side, is that if people listening to this and you would like them to take something away from today, just kind of one thing, what would you say that would be?
Well, look, George, thank you for being so appreciative of the conversation and of what we're trying to do here. I'm pleased that you feel it might be relevant to your followers, but also to the industry, the role that we seek to play. That we literally want to offer a journey that we think by design enables people to build that confidence, that reassurance to stay the long-term journey, because that's really where your best investment outcomes come from. And I think, if I was going to summarize it all, I would say that because we only run one fund, we have one investment process that is capturing as many sources of return, sources of risk, and valuation metric. One fund makes us uniquely focused in this industry. All our money is in it. And we think those are aspects of that value proposition that you're talking about. We're offering it at some of the most competitive fee rates in the industry, 40 basis point management fee. And if we got the flows, we could go lower. There's no doubt about it, because every pound of assets into the fund goes straight to the bottom line. We're running a very lean ship. We haven't had a single trading error or breach in over 10 years of operation. Again, that should be a source of reassurance and confidence to people. So we're lean, we're focused, we're completely aligned, and that package was very much what we came out of the financial crisis feeling that we had to offer. There was an opportunity in the marketplace that we thought people would need and would indeed value that. And we think if we keep prosecuting this philosophy, this activity, and we keep doing it well, we do have a role to play. And we look forward to acquiring any new clients and investors for the long-term journey.
Well, thank you very much, Joe and Christoph, for your time. And as I say, just a fascinating discussion. And I think, as I said, just to repeat myself, I think there's so much that we could unpack from this. Obviously, anyone listening to this, if they'd like to learn more about Tellson's, then their website is tellsons.co.uk. And I'm sure that they'd love to have a discussion with you. Thank you very much.
Fantastic, George. Thank you so much.
Thank you, George.